$20 super chat already on there. 13 likes. Awesome, man. Keep hitting that like button while we go through that. This is probably going to be one of the most important videos that you are going to be watching as far as understanding what's going on with the interest rates and the possible rate cuts that are coming in September. I have on this channel been trying to share with you the forward guidance monetary policy. Now, this is very, very difficult to wrap your head around, as most people look at the Federal Reserve in the classical form and that their main policy tool is interest rate adjustments. It's not. It is their words. Their words is the key monetary policy tool. And now what I have left for you down in the links or down in the description is two links. One of them is to a news article interviewing Philadelphia Fed President Harker. And then I also left a speech from Michelle Bowman. Now, Michelle Bowman is a voting member of the FOMC, the Federal Open Market Committee, 12 voting members on monetary policy. Michelle Bowman is one of them. Harker is not. He is not a voting member of the FOMC, so he has no vote. Now, however, the headline of this article is so misleading. Now, this is done on purpose. I'm going to show you how the credible threats work in real time. It's happening right now, and this is proof of it taking place. Now, before we get started on the credible threat of it, it's best to understand what the credible threat theory is. Now, the credible threat theory comes from a Ben Bernanke speech from way back in 2002, where they knew they were going to run into the lower bound of zero and they would no longer have the ability to adjust interest rates as their monetary policy. He knew that that was going to be a problem, but it was okay because they have another way of dealing with the monetary policy outside of the interest rate adjustments, and it's literally forward guidance, signaling, jawboning, or what I like to say, credible threats. Now, I'm going to share with you very quickly the speech, the Ben Bernanke speech. Again, I didn't leave this down in the link. I just want to share the story so that you can get your head wrapped around the idea of how the credible threat works. Again, this is directly from Ben Bernanke. Knowing that they were going to run into the lower bound of zero, monetary policy was coming to an end, and this is the new tool that they are going to use. Now, he tells a story to describe this new tool. All right, let me get into it here a little bit. A little parable may prove useful. Today, an ounce of gold sells for $300 more or less. Now, suppose that a modern alchemist solves his subject's oldest problem by finding a way to produce unlimited amounts of new gold at essentially no cost. Moreover, his invention is widely publicized and scientifically verified, and he announces his intention to begin massive production of gold within days. What would happen to the price of gold? Presumably, the potentially unlimited supply of cheap gold would cause the market price of gold to plummet. Indeed, if the market for gold is to any degree efficient, the price of gold would collapse immediately after the announcement of the invention, before the alchemist had produced and marketed a single ounce of the yellow metal. This is the heart of the credible threat theory. Now, if you can understand that their words, right, if they were to put out these words that gives the credibility to the markets that this outcome is going to be there, then they will begin to act accordingly. Okay, so again, if you haven't ever heard this, it's probably going to be mind-blowing to you trying to understand what it is that's being communicated here, but it is literally their words that they put out there that people then hear and go, oh, I need to react to this. We are finding that taking place right now with the rate cuts. Okay, so now I'm going to share with you, again, this is another speech, and I do apologize, this one is not in the description, but this is coming from Philip Jefferson, who is a voting member of the FOMC. All right, so this guy he gave a speech on May 13th, 2024, communicating about monetary policy. That's the title of the speech, communicating about monetary policy. So if we cruise down in this speech, it's almost to the very end. This is what he has to say. Talking about the communication coming from the Federal Reserve about monetary policy, he says this: surely sometimes central bank communications can have unintended consequence. Let me give you two examples. First, there is always a risk that policymakers' statements about their economic outlook or their expected future path of the policy rate are interpreted by the public with a false sense of certainty. A false sense of certainty on this economic path. Now, I'm going to take a quick break here and move over to the news article, which is linked down in the description. And this is what it has to say in this news article about, I don't know, maybe halfway, I guess. Let me see if I can find it here. Okay, the Fed, okay. With the markets pricing in a 100% certainty of a quarter percentage point or 25 basis point cut, and about a 1 in 4 chance of a 50 basis point reduction. Let me repeat that. With markets pricing in 100% certainty. Well, they're 100% certain. Market is 100% certain about this. But yet, even in this very same article, just one sentence above that, or what I mean, is it one? Or no. Directly right after that, this is what he has to say, quote, right now, I am not in the camp of a 25 or 50, meaning how many basis points, quarter point or a half a point, half a percentage, right? I need to see a couple more weeks of data. Literally, the article is saying 100% certainty coming out of the markets, but yet the Fed official here, who is not a voting member, right? Remember that, is saying, I'm not in the camp of a 25 or 50 basis point. Basically, straight up said, no, I'm not. I'm not in it. I'm not 100% certain, but the markets are. Right? And this is because this is the information that is being pushed out there on the mainstream. I mean, literally, the article's title itself is Philadelphia Fed President Harker advocates for interest rate cut in September. And then quoted, right now, I am not in the camp of a 25 or 50. I need to see a couple more weeks of data. Like literally contradicts the exact headline, right? Done on purpose. This is the key. This is part of it, right? This is a key component of the credible threat theory. I know. Stick with me, guys. This is. I know it's tough, right? So now I'm going to go back to the Philip Jefferson speech given back in May, right? When he talks about, again, first, there is always the risk that policymakers' statement, much like Harker, right, about economic outlook and their expected future path of the policy rate are interpreted by the public with a false sense of certainty. Markets are 100% certain of a 25-point cut and a 1 in 4 chance of a 50% or a 50 basis point cut. Right? Certainty. Okay, he goes on. For example, a data-dependent forward guidance announcement can be mistaken for a commitment to the fixed path of interest rates. How many people believed that there was a committed path, even though the Federal Reserve says a data-dependent forward guidance? Even Harker in the article said it. Well, let me bring the article back up here. Even he said it in the article, right? Right now, I am not in the camp of a 25 or 50. I need to see a couple more weeks of data. He even said, like, no matter what, they always end it with an out, with an out, right? 2% over the long run, because they don't have a target. Right? We are going to be cutting rates data dependent. If the data, right? So if they put all these ifs in there, then they can do whatever they want at the end of it. But the market is 100% certain. Who's not 100% certain? The Fed. Why? Because it's done on purpose. Continue on to the speech. Back to Philip's speech. Do I have enough time to do this? Yeah, okay, we're 10 minutes into it. Somebody told me that I need to make these videos shorter. I can't. I can't get the information out in a shorter video. Right? It's just, you have to work at this. It takes time, guys. You have to stick with it. And thank you, all 242 with the 60 likes right now. Keep hitting that like button, guys. All right. When the interpretation is proven wrong down the road, it can create more volatility and uncertainty than if there had been no announcement. Like they know when they go out there and use a bunch of words that it's going to create volatility and uncertainty. They know it does. Think about what happened with the dot plot back at the end of the year. Everybody lost their damn mind thinking there was going to be 7 rate cuts. That completely faded away, right? But the volatility and uncertainty that came from it was absolutely extreme. Right? All right, moving on. They do that on purpose, remember, right? There is that it can be interpreted wrong down the road, which can lead to volatility and uncertainty had there been no announcement. So they know announcing it can create this situation. They know it. That is why policymakers always make sure to stress data dependence of future policy. Always end it with an out. If this happens, if data, right? Always ended with the data processing, right? It needs to, if the data dependence. Okay, second, it is also possible that the public misinterprets the view of individual policymakers as a committee view. Remember, we're listening to Harker right now. He's not even an FOMC voting member, right? But yet here's this news article talking about how he is in support of interest rate cuts. So everybody sees this headline, even though he's not even in support of it, but they see the headline. They don't really process the information or even read the article or know what's going on. And so therefore, they just look at this headline and say, yeah, the Federal Reserve's approving of rate cuts. But this isn't even a voting member, and he didn't even approve them. Neither one of those things. Like the headline's a complete damn lie. You know? All right, moving on. The potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. Like, I'm going to show you right now here in just a second how Michelle Bowman just 2 days ago gave a speech that is completely different from what the narrative is out there in the mainstream media. I'm going to share that with you here in just a minute. That's the important information here, guys. 288 people watching, you haven't heard nothing yet. All right, you're about ready to hear the good stuff. Keep hitting that like button. All right, the potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. Like they know it. If we disagree with each other, all right? The diversity of viewpoints among policymakers lends itself to stimulating debates. Oh, yeah, it does. Think about all those economists out there who are talking about how much it needs to be cut or whether it should be cut or whether it should be raised and all the other stuff that they're about. They do that on purpose because there's so many of them who are disagreeing. The policymakers I'm talking about. They do that on purpose to create that uncertainty. Why? The diversity of viewpoints among the diversity of viewpoints among policymakers lends itself to stimulating debates and ultimately better policy. They are pushing that information out there, getting that thing round. Nobody knows what's up, right? They're like, they're totally in the what if moment. Like, what do we get? What up? When the Fed comes out with a statement of certainty, talk about the power that it drives into it. Right? It ends up being better policy when they go from uncertain to certain. Think about it. Like there is so much uncertainty taking place. Even within the article, the market is 100% certain, but the person that they are quoting isn't. From the Federal Reserve, he's not, right? And yet the headline says he's approving of interest rate cuts. It's right. You can't even make this stuff up anymore, right? Once you see it, once you recognize it, once you know it, once you know the credible threat theory, it is so clear. It is so clear. Like all this uncertainty and you know, misinterpretation and stuff like that, it's obvious. It makes so much more sense on what it is they're attempting to do. All right. But in such a situation, more communication could increase rather than reduce the uncertainty about the policy. Okay, so we know that they use those words. They know that they use the uncertainty. They know that if they have a bunch of people talking at the same time, it'll raise that uncertainty. Now, we are going to go to the Federal Reserve speech given by Michelle Bowman just 2 days ago, right? August 20th, 2024, title of the speech, Remarks on the Economic Outlook and Financial Inclusion. Now, I'm not going to read the whole speech, but I am going to read a section of this that is probably one of the most telling things about the belief and thoughts of the Federal Reserve right now. And it comes down to jobs. So let me go through this. I'm going to read it and then we're going to break it down. We got 15 minutes into this. We're probably going to go for at least another 15 minutes here, guys. I'm trying to keep it as short as possible. Like, you can't do it, right? You've got a lot of information you need to process here, and it can't be done in a 1 minute TikTok video, right? I mean, I've learned that right now. All right, the labor market this is Michelle Bowman's speech. Remember, Michelle Bowman is a voting member, very much like Jefferson is a voting member. She's a voting member and a very influential one. There are so many speeches given out about monetary policy right now that she has given. It's just incredible. So she is very much in the middle of monetary policy decision making. Okay. And nobody even knows who this lady is. That's what's funny about it. The people who are most important and influential in our life, these 12 voting members of the FOMC, and nobody knows who they are. Okay. On to the speech. 2 days ago, voting member of the FOMC, Michelle Bowman, says this: the labor market continues to loosen as the number of available workers has increased and the number of available jobs has declined. This is the biggest worry that a lot of people have, saying this is the reason that the Federal Reserve is going to have to raise rates. Big deal. A very big deal right here. Signs that illustrate the labor market is coming into better balance. Coming into better balance. It was way out of balance. There was far more jobs out there than there was people, right? But that's coming into better balance. Coming into. Listen to her words. Not there, not past, not unbalanced. Coming into. Getting there, right? After slowing in the second quarter, payroll employment gains eased to a more moderate pace in July, even as job openings are being filed by an increased immigrant labor supply. The latest labor report shows that unemployment rate stood at 4.3% in July. Although notably higher than a year ago, this is still a historically low unemployment rate. Very important to understand. Like, to us and everything that we have experienced, we are very short-minded as people. We only look at the last few years and think about it, but really it's a much bigger story, much longer. And if we go back in time, we can really see that the unemployment is not that high. Not yet. Not according to their numbers, which I know a lot of people are going to talk about fake numbers. I get that. I can do a whole video on that one as well. Right? But we have to go with their numbers because they're the ones who are in charge of monetary policy, and this is what they are using to conduct themselves. So we have to conduct ourselves according to what it is that they are doing. Okay, so regardless if it's right or wrong, this is what it is. Right? We are also seeing a slowing in wage growth, which now stands at just under 4% as measured by the Employment Cost Index. However, given trend productivity, wage gains remains above pace consistent with our inflation goal. Very important. Did you guys hear it? However, given the trend productivity, wage gains remains above the pace consistent with our goal, with our inflation goal. Uh-oh. Still, you're earning too much money too fast. Right? That's a problem for their inflation goal. Right? So sounds like to me like they're still doing a little bit of work, right? It's coming into better balance and it's still not coming into line with their inflation goal. These wage gains, right? I know to us, we look at it much different. We're like, hey, screw you, let us get some wages, right? But that's not the way the Federal Reserve sees it because they have an inflation mandate to deal with, right? Now, this is important, right? Again, if all that wasn't important, this is very important to hear. Right? Because this is Michelle Bowman's baseline view. Again, she is very influential when it comes to monetary policy. I guess I can't speak. All right. Nice. 365 people. Keep hitting that like button. We got 117 likes. Let's get it up to 200 likes. I can't be out here all day. We're only going to be out here for maybe another 10 minutes. All right. My baseline outlook. This is Michelle Bowman again. And from her speech just 2 days ago, right? My baseline outlook is that inflation will decline further with the current stance of monetary policy. First sentence, what did she say? Right? What did she say? My baseline outlook is inflation will decline further with the current stance of monetary policy. This is a voting member of the FOMC who just said it. Current stance in monetary policy will bring this more in line with their expectations, their monetary policies. Does it sound like she's cutting rates? No, not from the unemployment and not from the wage gains and not from the inflation from her baseline view of where monetary policy currently stands today. So far, nothing about rate cuts. She goes on, should the incoming data continue to show that inflation is moving sustainably to our 2% goal, remember, their 2% goal is not a 2% target, it's a 2% average inflation rate over time, right? So that's very important to remember, right? Towards our 2% goal, it will become appropriate. See, she didn't say anything about it is appropriate or will be appropriate, will become. That means you will sit there and it'll occur, and now it will become appropriate to do something. It's not appropriate to do something yet. It will become, right? Remember, she just said it. Should the incoming data continue to show that inflation is moving sustainably to our 2% goal, toward our 2% goal, it will become appropriate to gradually lower the Fed funds rate to prevent monetary policy from becoming overly restrictive on the economic activity and employment. But we need to be patient and avoid undermining continued progress on lowering inflation by overreacting to any single data point. You hear the caution in her voice. She is just like, I'm not really interested in cutting yet. Like, the data's not there, it's showing up, it's providing itself, it's getting there, but I'm not just going off of that. We got a lot to look at here. And I'm not convinced yet. This is what I'm hearing when I read this speech. All right, but we need to pay, okay, where am I at? But we need to be more patient. Golly, I need my glasses, here we go. But we need to be patient in avoiding undermining continued progress on lowering inflation by overreacting to any single data point. Instead, we must view the data in their totality as the risks to the committee's employment and price stability mandates continues to move into better balance. It's not in better balance, it moves towards better balance, right? That said, I still see some upside risk to inflation, as supply conditions have now largely normalized, and any further improvement to supply seems less likely to offset price pressures arising from increasing geopolitical tensions, additional fiscal stimulus, and increased demand for housing due to immigration. If there is still rising pressure due to geopolitical tensions, do you find that easing anytime soon? I'm just curious. I mean, I don't really pay attention to a whole lot of that stuff. Like, on a daily basis, I know a lot of people like pour their heart and soul into that. So I'm guessing that there's probably not going to be a whole lot of relief of geopolitical tensions. Additional fiscal stimulus? Yeah, like the government's going to back off on spending. I don't care who the hell is president, right? In fact, they're already promising to spend a bunch. And then the increased demand for housing due to immigration. Do you see any relief to any of this stuff? Just think, like, before, like, to set everything aside for just a minute, right? Do you see less global tensions? Do you see less fiscal stimulus, less government spending, less government, waste? And do you see less demand coming from immigration due to housing? Are those three things that you see less of coming into the future? Probably not, right? That's probably not going to be the case. So all the things that we are looking at as individuals when it comes to the reasons that the Federal Reserve would be lowering interest rates is nothing that the Federal Reserve is looking at. Right? The Federal Reserve, the voting members of the FOMC, are looking at a moment in the future that it could possibly be appropriate, but not at this time. Not even the ones that they are trying to disrupt the information with, like Philip Harker over here, who even says himself, quote, right now, I am not in the camp of 25 or 50. What does he say? I need to see a couple more weeks of data. See, this is all the credible threat. right there. That was all the information. Now, I don't know how to deliver it to you any more than just keep refining it over and over again like this. And I know a lot of people who are probably hearing this for the first time are completely confused by all this. But now, just take for a minute that the Federal Reserve has been sitting on their hands. They have done nothing different with their interest rates. Nothing. It has been exactly the same for months, months and months. But look at what's going on with mortgage rates. Look at what's going on with the U.S. Treasuries. Look at what's going on with everybody's belief. Even this article is saying that it has 100% certainty. That is what the Federal Reserve uses. They use that. That 100% certainty is now putting the exact cut mentality occurrence as if it had already happened into the market. And it works. It's working right now. All right. Okay. 26 minutes into it. I hope you guys enjoyed the information. I'm going to go and read a couple of comments real quick. I'm going to go and check out that super chat. Thank you so much. From Crab Gemini. Thank you so much for that $20. UE, I'm confused. Oh, excuse me, guys. The Fed lends money to the banks who then lend money to the public. The Fed also buys government debt. Does this mean the Fed owns everything in debt? They can also buy foreign debt. Do I have this right? They could buy foreign debt, but I don't think they really do. I think they leave that up to the government to deal with like the like the FX balance and stuff like that. Like I don't think the Federal Reserve, at least nothing that I have seen yet. Maybe there's some secret agency or something like that. Okay, very well, like the plunge protection team kind of thing. But I don't see where the Federal Reserve is buying foreign bonds to put on their balance sheet. Right? I don't see that. Now, when they buy treasury bonds, what they are doing is they are buying treasury bonds from the market. They don't buy it from the treasury, right? The treasury has an auction where they sell bonds. The people who come to auction are the primary dealers, which are the big banks. JP Morgan, Goldman Sachs, there's a bunch of them out there, right? So you got the primary dealers, they go to auction, they buy the bonds, they put those on their balance sheet. The Federal Reserve then goes and buys those bonds from the banks, from the primary dealers, and puts them on their balance sheet. So now, if you think about everything that's sitting on the bank's balance sheet, the Federal Reserve, right? The Federal Reserve's balance sheet, that's their assets. All the bonds, the mortgage-backed securities, gold, SDRs, like they got a bunch of stuff on their balance sheet. Now, what they have on the other side of their balance sheet is a liability. The liability is the bank reserves and the Federal Reserve notes, the cash that we use. Right? So that's how the separation is. So if you look at the cash and say, okay, what is this being backed by? Well, what's sitting on the bank's balance sheet? Right? Government bonds, mortgage-backed securities, SDRs, a little bit of gold. This is what the Fed's liabilities as opposed to the assets. Right? Now, to us, we don't look at the Fed's liability as a liability. We look at the Fed's liability as an asset because it's money. Right? It's cash. It's not even money. It's cash. It's currency. Right? And so we look at that liability as our asset. And that's essentially what is being backing our money, is the U.S. government debt and, essentially stock market, stuff like that. Everything that we back our money by or put our debt money to. So everything is debt. Everything. Like there's nothing that isn't debt, except for the physical thing that you hold in your hand. But everything else it's because the reason why everything else is debt is because everything else is priced in a dollar, and a dollar is a form of debt itself. Right? So everything is debt, unless it's a physical item that you hold. All right. Continuing on here. Let's go and go back to the live messages. All right, I got enough time. What time is it? All right. I got enough to do like one or two more comments or questions here, so let's cruise up. Hey, all-nighter, thank you for being here, bud. All right. I don't believe that. That would be fraud. Okay. With the way they are communicating, do they cut 0.25 or 5 in a month, in your opinion? I mean, what does it matter? This is the point. Like, why? Don't even stress about whether or not they're going to cut. That's not the point, right? Look at the communications. See this communication right here? You got the Federal Reserve with a, you have to set aside the cuts for just a second. That's the classical form of understanding the Federal Reserve. And I know this is difficult to do, right? Because we are been brainwashed our entire lives, social conditioned, all the mainstream media, all that stuff. It took me a long time to figure it out. I had to break free, right? Break free from understanding what the classical form of the Federal Reserve is and be able to hold it out and say, okay, this is that. This is that classical form of understanding the Federal Reserve. And now they have a communication about that. This is the monetary policy, not this. This is the interest rate adjustments and stuff. That isn't a big deal. The communication about it is. That's important. It doesn't matter if they cut. It's the communication that they are doing about it and what the market perceives. 100% certainty now has people behaving in the market as if the rate cuts have already happened. Think about that. Are you waiting for rate cuts? Why? They're already taking place. You see? They're preparing the markets. If they were to communicate it well enough that 100% certainty was now within the Federal Reserve itself, who is not 100% certain since they're data dependent. But if that 100% certainty was put into the Federal Reserve and communicated out there, and everybody knew it and behaved that way, very close to what they are doing now, when it comes time to actually cut rates, nothing will take place. Nothing will happen. All the positioning will have already occurred. And literally the next day will be no different from the day before. Now, if they were to cut rates, surprisingly, that would shock the markets. That's the way they used to do it. It's important to understand this. They have communicated this. If you go and read Philip's speech, he narrows this down. He actually describes it. We have broke this down many times in speeches. Just recently we go over it. I know 2 hours is long. You're not going to get it in 20 minutes, right? I mean, I gave out as much information as I could in 20 minutes. It was very difficult and it's still confusing, right? So this is the point. This is the point of it, is that when you look at whether or not they're going to be cutting rates, look at what the market is interpreting and look at what the Federal Reserve is saying. Are they very clear in communicating a rate cut coming into the future? No, they are data dependent. They have it on the table as a possibility. But the market is 100% certain of it. They are going to conduct themselves as if those rate cuts had occurred. That is basically a rate cut for the Federal Reserve. They didn't have to do anything. All they had to do was communicate it well enough. And it's working right now. You see it? Like, I can't explain this anymore. I mean, I do this every day. So yeah, this is how you explain it, right? This is how it goes down. And so now, if I'm not trying to predict what's going on in the future, let's take, for a hypothetical example, we get to September and the Fed comes out and says, yes, we have reviewed the data and it is now appropriate to cut monetary policy interest rates. We will do that at the next meeting. We are not sure by how much. What do you think the market's going to do? They are going to lose their mind and start acting even more so as if those rate cuts are occurring. By the time they get there to that meeting and cut the rates, everybody will have been positioned, no shocks to the market, right in line with what it is that they are looking to do. This is how the Federal Reserve is conducting business. It's their key monetary policy tool, not the classical form interest rate cuts. That's what everybody's stuck on because they don't know the credible threat theory, right? You don't believe it. Like, listen, I'm going to leave you with one more little tidbit here so that, remember, don't worry about the rate cuts, worry about the communication. That is the important part. All right, what speech am I on here? I'm on the wrong speech. All right. Let me get it up here. This is what... All right. Right here. This Mike Woodford, one of the developers of the new Keynesian model. Now, whether you agree with Keynesian economics or Austrian economics or whatever, it doesn't matter. This Keynesian economic models is what the government, what the Federal Reserve, all this stuff, we are living in the Keynesian economic world, okay? So the new Keynesian model put it this way: not only do expectations about policy matter, but very little else matters. Very little else matters. Like, it doesn't matter except for the expectations. What does the market think? That's the important part. Who has control over the market's certainty when the Federal Reserve isn't even certain? It's propagandized information that's doing it, right? I mean, I've made it very clear in their speeches that they are not certain about it. In fact, they want to see more data come out that is going to lead it better into better balance. Okay, Loretta. This is what Loretta had to say. Became president of the Federal Reserve Bank of Cleveland in 2004. She supported the continued use of forward guidance, right? All this jawboning, signaling, forward guidance, credible threat, right? The credible threat theory. She was in support of it, right? She was in support of continued use of forward guidance during these extraordinary times. Remember, this was back in 2014. In these extraordinary times, in particularly to communicate a lower for longer policy that could provide accommodations in the presence of the effective lower bound. They knew that if they told the public, hey, we are going to be lower for longer, lower for longer, lower for longer, lower for longer, they are going to internalize that and then start behaving in a way that stimulated the economy, and it totally worked. It totally worked. She also insisted that forward guidance could be used effectively even in normal times as a means of clarifying the FOMC's reaction function. They are using it today. They are using it right now. And there's no reason to think that they are not. And once you see it, once you understand it, once you know it, and you find articles such as this and the communication coming from a voting member of the FOMC just 2 days ago in a speech that is given to the other central bankers and not to the public contradict everything that you're finding within the articles out there on the mainstream media. What do you think is going on? They got two communications here. The one that they are using to conduct their monetary policy, and the other one is to the other central bankers out there. Man. It's so obvious to me, and I'm trying to share it with you guys, right? You're only going to get one chance at this. Once it's gone, it's over, right? All these people who are insisting that the Federal Reserve is going to be cutting in September are actually leading into the reasons that the Federal Reserve won't even need to do it, right? The communications coming from the Federal Reserve is the ones that you need to listen to, not the mainstream media. And this is why I encourage everybody to join the channel. $1 a month, you'll have access to all kinds of membership-only videos where we have broken down these speeches. In fact, I probably will do a members-only video for this particular speech given by Michelle Bowman, even though what I have given you is probably the heart of everything that you would need to know within it. But understanding the speech in itself is very difficult. It's boring. It's complicated. And when you have somebody who has been researching this stuff like I have for the last 20 years and poured through hundreds of these speeches, I can break it down in a way that makes it more understandable for the average everyday dude, right? Or girl, or whoever following this, right? And then once you get it, then you will see it. Like all these people, think about all the people who are convinced, 100% certainty within the markets, but yet Harker, who's not even a voting member of the FOMC, isn't certain. Neither is Michelle Bowman, right? And in fact, Philip Jefferson was saying just a few months ago that the communication of it can be misinterpreted and actually add power to the monetary policy. Like, that's what I heard. I know that's not exactly what he said, but that's what I heard. You know, it leads to better policy. How could it possibly be better policy unless it was performing better due to the fact that the uncertainty could be clarified and then drive that power into the market? It's obvious. It's so obvious now. All right, guys, I want to keep going, but I can't. I got to go back to work. It's been a beautiful live stream here. I think it was full of good information. I'm sorry I didn't go through all these comments. There was a ton of you guys talking. And I really appreciate that super chat. I really appreciate everybody hitting that like button. Share this video. Get it out there. This is what the people need to know. This is the information that people really need to understand and recognize. Right? So when you recognize the credible threat on your own, many people are recognizing this now. Like, they have gone through so many of my videos, heard me talk about this, that when they are out there conducting themselves, they are recognizing the four economic theories. They are recognizing the credible threats. They see it. They could see how the people's reaction to the propagandized information is leading them to investments, leading them to do sales or purchases or something of the nature, and they have completely misinterpreted the information. And the Fed knows that, and they use that. They use it, right? It's like the greatest gaslighting in history. All right, uneducated economist, you guys let me know.